The most expensive line items in a multifamily deal are rarely the ones in the spotlight. The deck talks about rent growth and value add upside. The expenses get a line, sometimes a total, often a percentage of revenue, like expense ratio of 42%. Now, percentage feels like a finding. However, it is actually a starting point for us to dig deeper. Five expense lines deserve more scrutiny than the offering deck usually gives them. Number one, insurance. Premiums in many markets have doubled or tripled over the past few years. Florida, Texas, coastal and Gulf states have seen the biggest increases. If the underwriting uses the seller's current premium, the buyer is inheriting a quote that may not renew at the same price with the same carrier or even at all. Property tax is number two. In many states, the assessed value resets upon sale. The seller may have been paying tax on a basis from 5 years ago. The buyer inherits a stepped up basis. The reset can be 30, 50% or higher than what you see in the trailing 12 months. And a deal that ignores the reset is showing you tax expense on a property that no longer exists. Number three is payroll. On-site staffing has gotten more expensive. Turnover is higher, and the trailing 12 number may reflect a property that has been thinly staffed, perhaps a member who's retiring, just operated differently, and not what a buyer may operate under. Number four, repairs and maintenance and deferred maintenance. They don't just show up as an expense until you after take over the property. Perhaps the seller was running the property lean to prepare for the sale. So if you're underwriting based on these numbers, you have a ton of catch up work disguised under a number that does not exist. Number five is utilities, where they're not master metered. Expense recovery from tenants depends on collection. Underwriting that assumes 100% recovery rarely matches reality or local regulations. These are not exotic line items, they are the operating spine of the property. The question worth asking when reviewing an offering deck is simple. For each major expense line item, is the underwriting using the trailing 12 months, the seller's number, or a market validated forward number? And if it is the seller's number, what is the bridge to what the property will actually cost to run? If the sponsor cannot answer that line by line, the expense side of the model is not built. It is borrowed from the seller or unrealistic projections. This is not underwriting. If this was useful, subscribe and leave a comment. And if you are reviewing a deal and want a second set of eyes, send me a direct message.